This is Chapter 8 for a business introduction to business class. I'm doing it on a YouTube video so you can hear the sound and see the PowerPoint displays. And hopefully it's only going to be a little over an hour. So I want you to listen to this video and then read Chapter 8 and read Chapter 9 for next class, next Wednesday. Chapter 8 is on accounting and what does accounting mean and how is it used in businesses today, and lots of issues in this chapter. First we're going to talk about what is accounting and how is accounting information used in a corporation or even in a small company. There's lots of different types of accounting. A great field to go into if you're looking for a field. What are the goals of generally accepted accounting principles? There's standard principles that all accountants go by and all businesses go by. What are the key elements of major financial statements? We're going to go through the major financial statements that every company has. What are the methods stakeholders, the people interested in the company, can use to obtain useful insights from the company's financial statements? As we remember, stakeholders are the owners of the company, the community at large, the customers of the company, and the vendors, as well as the banks that are giving loans. All of those have a real interest in the company and called stakeholders. Also, we're going to talk what is the role of managerial accounting instead of financial accounting, managerial accounting, and what are the various cost concepts identified by managerial accountants. And lastly, how does the budget process help managers plan? So it's going to be a budget process that we're going to be talking about. Accounting, who needs it? Managers at all levels, but especially marketing and financial managers need the accounting. There's outside accountants, there's inside accountants, and accounting is used by every company, and especially if it's a public company, then the stockholders as owners need to know how the company is doing. Besides the managers inside the company. Employees need to know how their company is doing. Last thing you want to do is find out that your company is on the verge of going out of business and you haven't had the time to look for a job or whatever. And it's always important to know how your company is doing whenever you're working at a company. And the financial reports are the way to determine how your company is doing. Even if it's not a public company, all companies do financial statements and should make them available to the employees. Also, creditors need to know how the company is doing, and especially if they're looking at lending money or advancing credit to a company, they want to make sure that the company is doing well, and they can tell by the financial statements. And there are other groups that are interested, the IRS, because every company has to file income statements. The Securities and Exchange Commission, if it happens to be a public company, needs to know. Suppliers of the company need to know what's going on, especially if they're not being paid up front for the supplies that they're giving to the company. Accounting, who does it? What accountants do? Public accountants, there's all different types of accountants, but public accountants handle many accounts and work independently from companies. And they typically are certified public accountants, and they work individually and are hired by companies to come in and do their books or do their taxes or whatever. So there's a lot of business for individual accountants, public accountants. Forensic accountants, and they help the IRS if they're doing an audit, or the SEC if they're checking on a company, or sometimes even help with the police if they want to go into the financials of a company. So there's forensic accountants, they're called. And then there's management accountants, which work in-house and help the company itself analyze how it's doing, how it should be working in the future, what areas are working better than other areas, what products are working better than other products. And then there are internal auditors, which also work in-house, but they're checking the books to make sure that the financial statements that the managers are coming up with are actually valid and done the right way and prepared in accordance with the standard of accounting procedures. And then there are many government accountants analyzing each of the agencies within the government, but also helping the government analyze companies out there, like working for the IRS and doing audits, etc. But many, many government accountants. Accountants require expertise. It's not easy to become a certified accountant, and it's called CPA, Certified Public Accountant, and it's a certification that you get, and it's not easy process. As it says here, 150 semester hours of college, so at least 5 or 6 years of college, and then you take a rigorous exam, and most people do not pass all the parts of the exam on the first try. And then, even if you pass the exams, most states require at least a minimum of working for a year for an accounting firm in order to get your certification. And then there's additional certifications you can get. Certified Management Accountant. This is someone who's certified not as a public accountant, but as a management accountant. And then Certified Fraud Examiners are the ones that do the auditing, either internal auditor or external analyzing public companies. So there are lots of different roles that accountants play. Financial accounting is the first type of accounting we're going to talk about. Financial accounting is the branch of accounting that addresses the needs of external stakeholders. So this is the ones that do the reports that are seen by external people, by external members of the community, by external stockholders, by whomever it might be, creditors or vendors of the company. And as it says here, stockholders, creditors, government regulators. They're the ones that put the financial statements together for the company that are seen by the outside world. Financial accounting includes financial statements to provide broad information. So the financial statements is pretty much where their expertise is. But there's lots of other things that the financial accountants do. But the main goal is to prepare financial statements that the world at large sees. It would be very difficult if each set of financial statements was done in a different way from every other financial statement. So long ago they came up with standard procedures for the financial statements, and they're called the generally accepted accounting principles, which have been accepted by all the states in the U.S. And accounting standards that are consistent and used in the preparation of all these financial statements. So GAAP is the term that you will see many times when you look at any financial statements, and GAAP stands for the Generally Accepted Accounting Principles. The GAAP is regulated by a board, the Financial Accounting Standards Board, that is a private group that regulates and establishes and enforces the GAAP standards and determines whether they need to be changed and determine what they should be in the first place. And they want to make sure, as it says on the right of the slide, that the statements are relevant, which means help understand the financial performance, so they really have a bearing on the true financial performance of the company. They're reliable, which means they're accurate. There's not any fraud involved in it. And next, that they're consistent. That you can look at one set of financial statements and compare it to another company, and you know that they're consistent. And then they're comparable, which means the statements look the same. You also need to have a few years of analysis comparing year to year as part of the financial statements, and we'll talk a little more about that in a moment. Video. I wanted to show you a video of called The Little Guys, and it's a company that we can talk to next time. I'm going to probably try and show these videos at the beginning of class next week, but we'll see if we have enough time to do this. Go through the midterm and then do chapter 9. So, but my aim is to show these videos next time. I can't show these videos. They're on a disk that doesn't allow me to download or show them on any other format. Ethics in accounting. As hopefully you all know, in the late 1990s, there were lots of accounting scandals. One of the reasons the economic downturn started because of the accounting scandals that were rocking large businesses in the U.S. Enron, Tyco, WorldCom, Adelphia, just to name a few. Cape Cod Community College I threw in here, but there really weren't any scandals involving Cape Cod Community College. But it's important for every college to have high ethical standards in their accounting procedures. But the problems with Enron, Tyco, Adelphia, the CEOs and top executives ended up in jail, and the employees lost all of their pension funds. At one point, Enron was one of the larger corporations in the U.S., and they were hiding a lot of the debt that they had in separate entities under Enron, and at that time it was legal to not have to report these other entities, so they hid the real problems that were coming up, and yet the CEO and top executives were telling how great the company was doing when it really wasn't true. And then the company went out of business, and again all the employees lost their jobs, obviously, many thousands of employees, and then lost their pensions, which they had been saving up the entire time that they had been working there. Most of the people that had 401ks, which you have at most companies today, was investing in Enron stock. So when Enron went out of business, the stock was worthless, so even their 401ks were worthless. And similar types of things happened with Tyco and WorldCom and Adelphia. But these scandals were a real wake-up call to the profession, and it caused lots of changes in the requirements for accounting practices within companies, and especially public companies. State boards began passing ethics-related requirements, and then it became passed by the U.S. legislature and applied to all public companies. Only public companies, not private companies. Accounting fraud as American as Wiener Schnitzel. Everyone thought that this just applied to the U.S., but it turns out that it was worldwide, and a lot of these issues came out after the U.S. had problems, and it turned out that there were lots of issues worldwide. European observers suggested that the accounting scandals were from American greed, lax regulations in the U.S., etc. But it turns out that Europe had many of its own scandals after that because people were now checking the corporations that were outside the U.S., seeing if there were similar problems to what was going on in the U.S. As it says here, European regulators were less diligent than their American counterparts, so it turns out that there were lots of scandals in Europe also. Financial statements. The three main ones are the three listed here: balance sheet, income statement, and statement of cash flow. And every business, I'm the financial treasurer of my neighborhood association, and we put together a balance sheet and an income statement. We don't have a statement of cash flow because we have very little cash flow, but we have a meeting probably every month, and I put together a balance sheet and an income statement to show exactly where we are at that point in time, so that everyone on the board can see what is going on. So these are the three basic financial statements that we'll go through and that you'll need to know somewhat about, at least what they mean. A balance sheet is showing the financial status of the company at a specific point in time. If I ran it today in April, it would be as of today, and it would show the amount of worth of the company at this point in time. An income statement is typically over a period of time, and for my neighborhood association, our fiscal year runs in July 1st because that's when everyone's around. A lot of summer people are here, and in the winter very few people are around the neighborhood, as it is with most areas on the Cape. But the income statement runs from July 1st up until the time that we have our meeting, and it shows the profit and loss over that period of time. It shows all the income coming in and all the outflow, all the expenses going out. We don't have any salaries. Everyone's a volunteer, so we don't have those expenses, but we have lots of other expenses. And as a statement of cash flow, in most businesses, it's important to understand the cash flow because you need cash to pay for salaries for employees. You need cash to pay for debts that are due, rents on buildings, new equipment, supplies to make your products, etc. So it's very important to keep on top of the amount of cash that you have. The last thing a company wants to do is run out of cash, have no money in the bank to be able to pay, and have to wait for the sale of products in the future to bring cash into the company. Which is why a lot of companies need to have loans out to cover that period of time until they have the money coming in from the sale of products. Corporations with publicly held stock, public companies, must publish annual reports with these three statements, and they need to be audited by outside non-related public accountants, and we'll talk about that in a moment also. First of all, the balance sheet, one of the three financial statements. It shows what's owned and how you got to that point and what the issues are. Balance sheet summarizes the firm's financial position, again, at a specific point in time. It shows the assets, what the firm owns, what equipment it has, what buildings it might own, what vehicles it might own, all of the assets of the company. Then it shows the liabilities, what the company owns to banks or to creditors, to non-owners, to non-stockholders of the company. And third, the owner's equity. And this is if the company closed today, what the company would be worth and what the stockholders would get from the company. And the equation that's used is called the accounting equation. It's assets equal liabilities plus owner's equity. So it's really the assets equal the liabilities, or the assets minus the liabilities is how you come up with the owner's equity. You take all the assets that the company has minus all of the debts that are due, and that should equal what the value of the company is in that specific period of time. But the form is in the assets equal liability and owner's equity. This is what a typical balance sheet looks like. I'm not going to go through it in detail, but it's really the assets come first, and it shows the cash on hand, the accounts receivable, the amount that's actually due the company that you know is going to be paid in a short term, all the inventory items that are sitting in the building or buildings, multiple buildings, and then all the value of the facilities, the property, equipment, etc. And that gives you a total of the amount of assets. From that, you take away the liabilities, which are the accounts payable, how much you owe other people for the supplies, for the equipment that you have, the salaries that you owe people, not future salaries but current salaries that you owe people, and hopefully it's just for a week or two, and the long-term liabilities, any long-term debts that you have out that you're paying interest on. Total that together, that gives you a liability, and the stockholders' equity is the difference, and it's the assets minus the liability gives you the stockholders' equity, and that's how the numbers work out. You can see the numbers here. The next statement is called the income statement, which is really how the company is doing, the profit or loss of the company, and it summarizes over a period of time the operations of the company. Is it making a profit? Is it having a loss, etc.? All of that, and this formula is the revenue, anything that comes in to the company, all the revenue over that period of time that you've earned, minus all the expenses over that period of time, and either you show a positive income or a loss. And hopefully in most companies it's a positive. A lot of companies at the end of the year, in order to have less income, put lots of money into new equipment and new facilities, so that they pay taxes on less profit to the IRS, to the federal government. This is what an income statement looks like. Again, it's the revenue, and from that revenue you have to take off the cost of the goods that brought that revenue in. If it's a services company, you don't have any cost of goods sold. And from that, you take off the operating expenses, which are any selling expenses, administrative overhead, rents, utilities, all of those type of expenses, and you get to a net operating income, which is just revenue minus typical expenses, and then typically to that you would take away any interest expense, and those are just done separately from normal expenses, just so that you can see what interest is out there, and then taxes. But a lot of companies just lump those in under operating expenses, the interest and taxes, and you end up with a net income. And in this case, it's $101,000. So they made a profit, and most companies wouldn't show a dividend, but the income statement just ends at the net income or loss at that point. The dividend is for a public company if they're paying dividends. And typically it's paid out of the profits that they earn, and the difference is transferred to retained earnings, which is in the company and could be divided by the stockholders if they decided to give a larger dividend. Statement of cash flow again just shows what's happening with the cash position of the company, cash flowing in and out of the firm from operations, investing, financing, all sorts of things that every company gets involved in. It increases and decreases over time, but it really shows the amount of cash that's on hand when the report is run. As it says here, stakeholders want to know if there's adequate cash to pay workers, to pay creditors, to pay suppliers, to pay the IRS, all of those types of things. You know that there's more money coming in the future, but for a period of time, you have to have enough cash to cover those expenses. And it's the taxes on buildings, or the rent if you're renting space, the salaries of people, and any loans that you might have out with banks or creditors. This is a typical statement of cash flow. Again, it shows the operating cash flow. It's what money is on hand, and you notice that the $804,000 comes from one of the prior statements that we did. The purchase of inventory is a negative. Cash operating expenses is another negative. So the net cash provided from operations is a lot less than what the cash, what the revenue was brought into the company, and then it shows here what investing money brought in, and then the financing cash flow. It's bank loans that the company took out to bring money into the company, minus whatever was paid out during that period of time. So the bottom line is the total cash flow adds all those up, and the cash at the beginning of the period is added into that, so that now you show a cash at the end of the period that you're talking about. And in this case, they had $188,000. For a small company, that's a lot of money. For a big company, that's not a lot of money. And it's not enough cash probably to even pay salaries of employees for a period of time. Again, another video on Pizzeria Uno, which is one of the more successful pizza chains around. It's mostly privately owned, but very successful. And one of my good friends was one of the buyers for Pizzeria Uno, and very, very successful. Hopefully we'll have time to show the video next time. Interpreting financial statements, and the author's talking about digging beneath the initial statements. When you look at a financial statement from a public company, number one, it needs to be done by an independent auditor, and so there's no conflicts of interest between the accountants that did the auditing report and the company itself. That used to not be the case, but it's required now by law, and it's required that there are all sorts of reports in addition to the 3 financial statements. So when you read a report, if you're a stockholder in a company, annually they'll give you a thick report, many pages, and there'll be those 3 financial statements, a lot more complicated than we showed here, but a lot of additional reports. And there are notes to the financial statement, notes from the auditor. The auditors do more than just report the numbers. They actually check to see that the numbers were prepared properly, that the company is recording the numbers properly. They interview people within the company to make sure that they're recording everything they need to record. And also, as part of the reports, it's required that they analyze the last 3 years of a company, so you can see how the company has done over the last 3 years. The current year that's being reported on, so that the annual reports that are coming out now are for 2013, but that they're also required to give comparable reports for 2012 and 2011 at a minimum. So you can see how the company has been doing over that period of time. Independent auditors' reports, as I said, include lots of things. Publicly traded corporations are required to have an independent certified public accountant firm perform an external audit. As I said, it's a very rigorous process. They check the figures, but they also check the methods. They do physical counts, really. And they either issue an unqualified, which means they found no issue with the company's financial statements or methods that they used. A qualified if they found some minor reports, but typically before issuing a qualified, they would talk to the company and straighten out the minor problems. Or an adverse opinion if they really felt that there was a major problem with what how the company was handling its finances and how it was handling its methods. When I worked at Data General, every quarter they used to give reports, all of these figures, and it was very important that we have a push at the end of every quarter, every 3 months, to get stuff out the door so that they could show it on their books and show a higher profit. And at one point, they decided that what we could do is if we actually couldn't ship it to a customer, the products, because when we got to be too large to have lots of stuff shipped out at the same time, at the end of a quarter they were shipping lots of stuff. Trucks were backing up all day long for the last few days of a quarter. They decided that as long as they separated the items into a special designated area that was not owned by equipment that was not owned by Data General, but that was set aside for customers, that they could include those as shipped goods. And I'm sure they talked to their external auditors to verify that they could actually do that. Today, it probably would be frowned on. This was This was probably 20 years ago that I was talking about. So probably today they would not be able to do something like that. The author feels, and anyone in the financial field you talk to will tell you that it's extremely important to read the notes to any financial statements. It really gives you a lot more insight into how the company is doing. And there are a lot of notes that the financial statement gives. Part of it is the auditor's report, but there's also many other pages and many pages as to how the company is doing, how the different divisions are doing of the company, how the U.S. division is doing versus overseas division, and a report from the president, how he sees the future of the company. But it also gives lots of clarification and supplements to the numbers if it was prepared and they had to add things to the numbers and explain the accounting methods or changes to the accounting methods. Sometimes when they're comparing year to year, if one of the numbers looks way out of whack with a prior year, they need to explain why it's out of whack and what they changed to do that. And then also they need to notify any lawsuits that have been brought against the company and the status of those lawsuits. And when you look at a comparative statement, comparing year to year, you really need to look at how the company is doing. The SEC, Securities and Exchange Commission, requires them to have financial statements. As it says here, 2 to 3 years of figures side by side. I'm pretty sure it's 3 years required of figures side by side. For a public company that hasn't been in existence for 3 years, obviously you can do it for a shorter period of time. But it's a way to view changes over that period of time, so the public can see what how the company is really doing. And it really is a way to trace what's happening with the assets and the liabilities of the company, what's been happening over that period of time. Very few large companies stay stagnant over that period of time, so you can really get a view into the company as to what's going on. This type of analysis is called a horizontal analysis, where you're comparing numbers horizontally with comparable numbers over a period of time. So you're comparing equal numbers for a few years, for at least 3 years, horizontally across the same income statements. Inside intelligence, this is the managerial accounting. We were talking about financial accounting before. Now we're talking about inside accountants, managerial accounting. Managers rely on this information, heavily rely on this information to make many of their decisions. They need to know how each of the product lines is doing. They need to determine the price that they can sell their products for. Even small companies need to have all of this information. It's not to the extent that you do with a large company, but it's still very important. And this is used to develop how much money they're going to have available to pay for salaries, to pay for future product design, for research in certain areas, and for the manufacturing of new products. And that's how you get into budgeting. And we'll talk about budgeting right at the end of the chapter. Management accounting systems are a huge source of competitive advantage. It really gives the internal employees a lot of information about how the company is doing, and it's critical. In companies that don't have a good system, really run the risk of having real problems in the future. That's why the author's talking about it being a competitive advantage. Comparisons between financial and managerial accounting. The first column shows financial accounting. The second column shows the managerial accounting. I don't want to go through this, but you can go through it on your own. But quickly, the financial accounting is used by outside individuals. The managerial accounting is used by inside departments, divisions, managers, etc., etc. And it's a different type of reports that are generated. With financial accounting, there's strict guidelines as to what the financial statement should look like. And for public companies, it's a requirement that they meet the GAAP requirements. For inside, they don't need to go by the GAAP requirements, and they can really do anything they want. They determine internally what reports that they feel are important. So it's a whole different ballgame when you're doing internal auditing. Types of costs. So now we're getting into the nitty-gritty of running a business and talking about what expenses a company might have. And these are the terms of arts that you really need to know. Out-of-pocket costs are the also called explicit costs. These are the things that you actually lay out money for. Pay to suppliers, pay to employees, the rent of the space that you're in, the utilities for the space, the taxes on the building, all of those types of things. The implicit costs, which is the amount of the opportunity costs that you were giving up. And so that's somewhat wishy-washy, but it sort of falls out from some of these other things. Really, if you're choosing between two different products to manufacture, the implicit costs are the costs that you gave up by not making and not realizing a profit off of the manufacturing of the item you didn't choose. The author uses the example of a law firm that uses a building that they own for their business, and so they don't have to pay themselves any rent. That's the implicit cost of what they could have rented that building for. That's an implicit cost. What's the opportunity cost that they gave up by moving into that building? What was the rent that they could have been realizing? Then there are fixed costs, do not change with level of production. And these are typically the rents on the building, part of the out-of-pocket costs. The utilities that you pay on the buildings, sometimes it can be salaries if it's fixed salaries for employees. And then you have variable costs, which are rise and fall depending on how the products are doing. So it's basically the manufacturing costs of the items. If in good times you're making lots of products, so the variable costs are relatively high. You might be buying new buildings and obviously manufacturing product to put together the items that you're selling, and in bad times you slow down all of those, and so the variable costs would go down on those. So these are just different terms: out of pocket, fixed costs, variable costs, and implicit costs. There's different ways that accounting managers put the costs of direct and indirect costs and how they determine those. If you're looking at producing what it costs to make a car, if General Motors wants to determine what the direct costs are and what the indirect costs are for manufacturing one specific type of car that they have, because they want to compare it to how they're doing in selling that car. The direct costs are pretty easy. It can be directly traced to the production of those items, all the manufacturing facility, all the costs of that manufacturing facility for that specific car, the salaries of the people that are making the cars, all of those direct costs. The indirect costs are much more difficult because the company as a whole has lots of expenses that go into behind the scenes into making that car. It's the overhead of all the corporate people that work for General Motors that aren't directly involved in making that car, but still part of the company, part of the costs of running the company. So how do you divide up those indirect costs based on each product line that the company has? In the past, what the easy way of doing it is you divide up the indirect costs by what the revenue is that's being brought in by each of the product lines, and you split it up on a proportional basis. And they really determined that that's a quick and easy way of doing it, but it wasn't really a valid way of doing it. So they came up with this activity-based costing, ABC. It really helps in allocating much more complicated procedure, but in allocating the indirect costs to each of the different product lines that you have. But it really determines the factors involved in each of the product lines. If you look at a product, one of the cars that GM puts out, what are the factors that really go into manufacturing that car, and it becomes very complicated. What are the overhead costs that go into making that product line? And again, it's very complicated. Each company does it a little differently than the next. But if a company does it properly, it's a much more valid result to divide up the indirect costs. So you add the direct costs and the indirect costs related to that product line, and then you can really then analyze, is it a success or is it not a success, the costs associated with that whole product line. Budgeting is the process of planning for the future. What resources, what money, what equipment you're going to need, what manpower you're going to need for over the next period of time. Typically, it's over the next year, but upper management typically plans out a lot longer period of time, 5 to 10 years in the future. And what it really does, the budgets translates goals, future goals, where do you want to be in a year from now, into measurable quantities, and identify the resources necessary to get to that goal. So a lot of times you set a goal for where you want to be. How many cars do you want to sell by a year from now, and how do you get to that point? Do you need to hire more dealerships? Do you have to hire more people? Do you need to manufacture more? Do you need to have more advertising? All of those things go into that to meet that goal, that future goal. And it really requires a lot of communication, as it says here, and coordination among managers and employees to come up with accurate goals. There's two types of the way budgets are typically done. One is top-down, which are the managers at the top level, the top executives do the budget planning because they really are looking at the big picture. They know where the company wants to be, and they feel they better know than the employees and managers what's necessary to get to that goal. However, most companies decide that that's really not a valid way to do it. You really need to talk to the people that are working the product lines and whatever, and the managers and employees that are really doing the work to come up with it, and it's really bottom up. Uh, but a much more complicated. It involves not just the top executives, but the managers and employees, and ends up being a lot more complicated, but in most cases a much more valid procedure. And then you need to put monitoring uh, uh, procedures in place so that every month or every quarter or every 6 months you monitor how you are doing against those goals, how you're doing against the budget. So it's all part of the process of setting budgets and setting goals and setting monitoring ways of determining how the progress is going against that goal. And this is talking about the top-down budgeting, where top management prepares the budget, or bottom-up, or participatory budgeting. Um, Again, terms of art: top-down budgeting, participatory budgeting. And participatory budgeting allows middle and supervisory managers, as well as employees, to actively participate in setting the goals, in setting the budget, and in all of that work, and perhaps even in setting how do you monitor that you're on goal. A lot of top management feel that by allowing that to happen, the mid-level and supervisory managers typically inflate their numbers so that they look good if they reach the goal ahead of time or whatever. So they have to carefully discuss with the managers, is it really a valid number that they're talking about? And key components of a budget is the operating budgets. What's involved in the operations of the company? What are the sales budgets for selling the product? What are the costs involved in marketing and selling the products? What are the production budgets, the manufacturing procedures? What are the direct labor budgets? What are the costs of the salaries and the people that you're going to need in order to reach that goal by the end of the year? And then financial budgets, which are focus on how much cash you're going to need periodically during the year, the time the budget is running for. And the capital budget is part of the financial budget, which are what investments, what fixed assets are you going to need to reach that goal? Are you going to need to buy buildings? Are you going to need to invest in renting space, in buying new equipment? All of those types of things are part of the capital budget. And then the master budgets brings all those together, the operating budget and the financial budget, and you can have for a large company, a very complicated budget. It's all internal. It's not part of the annual report. It's not part of what goes public. It's just this is all internal, but very important for any company. How do you do accounting? This is for you personally. Do you use a personal budget? Hopefully most of you do. It's not easy to set up a budget and to stick with it, but it's important so that you don't get out of control. How do you monitor your budget? There's lots of different software tools that can really help you in this. Quicken is the most popular that most people use and most companies use. QuickBooks is made by Quicken, and it's a lot of companies use QuickBooks, and it's all the different reports are built into the system. So you just put in your expenses, you put in what you've laid out, and add in the proper items into all the different categories, and out pops the form, and they even have graphs and all of that's involved in it. And hopefully your short and long-term goals are in your budget, where you really want to be a year from now, or 5 years from now, or 10 years from now, and can you determine that from your budget? And how do you manage your finances going into the future? It really depends on your income level and where you expect to be. If you become unemployed, it throws your budget obviously way out of whack, and you have to factor that in. So that's why a lot of accountants suggest having a good cushion of savings in the bank in case the unforeseeable happens in the future. You have some disaster happen. Either your car breaks down, you lose your job, and lots of other things potentially might happen, and so you need a cushion for that. The homework that we had, why is it important to look at the independent auditor's opinion of a company's financial statements? And obviously it's because it tells how the company is doing, and how it whether the financial systems used were proper or not, and was it unqualified or a qualified auditor's report is very important to know. Sarbanes-Oxley Act, which is the legislature getting involved and making sure that the reports are in certain formats, but that also the external auditors that are doing the report have nothing to do with the companies that they're reporting on. Before Sarbanes-Oxley, back in the Enron days, the large accounting firms that were doing the reporting, the auditing of the reports coming out of a public company were done by companies that had major contracts with the company itself. So the last thing they wanted to do was to give a qualified report when it could perhaps jeopardize their future with the company. And what does it mean when an auditor renders a qualified opinion? We talked about that. Number two, what are the key differences between financial accounting and management accounting? Hopefully you now understand that financial is outside for all the stakeholders. Management accounting is internally, and lots of definitions of both of those. And number three, how do management accountants view costs? And again, we talked about the fixed costs, the variable costs, all of those different types of costs. And how do implicit costs differ from explicit costs? Not an easy concept again, but it's the things that you perhaps have given up in order to pursue the product line that you're currently in. And give some examples, and you're on your own in giving some of those examples. In this chapter, what we discussed was what is accounting, how is accounting information used, and all the different types of accounting. What are goals of generally accepted accounting procedures, the GAAP, and what is that? Why is it in place, and what's the purpose of it? And what are the key elements of major financial statements, the three financial statements that we discussed? And what are the methods stakeholders can use to obtain useful insights? And that's the annual report of any major company. And looking at the notes, looking at all of the different things besides just the financial statements. And what is the role of managerial accounting? And what are the very cost concepts identified? We talked about that. And how does the budget process help managers plan, motivate, and evaluate their organization's performance? And that's the whole budgeting process, setting goals, either doing top-down or bottom-up budgeting, and setting monitoring procedures during the year, etc. So this is chapter 8 on financing. We'll do some of the videos next class, and obviously for homework, what I gave you is to read chapter 8 and do the homework for chapter 8, and then read chapter 9, 2 chapters this week, to try and help us catch up a little, and then do the homework for chapter 9. Good luck, and have a great weekend.